Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day, all. Ira Epstein of Lynn & Associates with your agriculture update, and this is for Wednesday, and we are now on the 12th of April, 2017, and we're at about 1:50 p.m. Central Daylight Time. All right, my friends, as you can see, with the exception of July wheat, the grains were basically in a positive mode today. The cotton did close lower, as did the sugar market, and we've been dropping in the energies a good part of the afternoon now. In fact, the market's approaching the lows of the day, even though the market did see a draw on the EIA stocks. So interesting news there. When we take a look at the May soybean weekly chart, you've gone from 1080 now to 929 3/4, and we're off that low on a closing basis, about 20 cents at this point. You also now, if you look at July soybeans on a chart of only closes. I'm not going to use the May now. I've moved over all of the grains to the July. You might ask, well, why have I still got the May soybeans there? And the reason is that's still the lead month, even though I'm making the change because open interest and volume is moving already. But that thrust is upward from 948.5, a dime so far, to 958 3/4. You can see how the market made a new low on this move just recently and popped up today back over this congestion that it had. This has been the problem, this area right here. So you had a false move down, came back. Today you had a move up. Does it drop back? That's going to be the big question that you got to ask yourself. In terms of the swing line study, it says there's no trend. You've got the lower low, now you got the higher high. What do you do with that? You're well under the 18-day moving average of closes in red, so the bias is down. The 100-day average is far away. What about where the Bollinger Bands came in? Well, they come in down here, so this break back to 941 got nowhere near the 928 1/4, but what had happened is you were riding the lower Bollinger Band, kept hitting it. Now you've moved to the right-hand side. Is this short covering? Could be. Let's take a look at momentum. In the momentum, you're a smidgen away from losing the embedded reading. You have not lost it. You can gain it back tomorrow with a good break in the market, in fact, but the odds are very strong tonight that what's going to happen is when the market reopens, if it's anything near unchanged, you're going to lose the embedded reading. You've already lost it, as you can see, in the July meal. So what's the significance of that? Let me show it to you. When you have an embedded reading, which you had all this period, where both the K and the D lines, the red and the blue, are going sideways, under 20, it's often accompanied by falling prices. You do see that, I hope, because it's pretty crystal clear. And what did the market keep doing? It kept hitting the Bollinger Band and bouncing away. On Monday, remember, today's only Wednesday, the market sort of flattened itself out, started coming up on Tuesday, and you lost it today. What's my theme? This is Tuesday. When you lose an embedded reading, often, not always, but very often, price makes a run and the 18-day average makes its run. They come together. And this is just what's going on now. If you take a look at today's high, 317.90, you can see it right here. And if you look at the 18-day average, 317.80, and the market hit it, backed off a little. So now it has to rebuild. This is a chart that's no longer trending. It still has downside bias since it's under the 18-day average of closes. Should it take off to the upside? Well, I think it's pretty clear. You've got big resistance at the upper Bollinger Band and the 100-day average of closes, but I am not saying it's going there. I'm just giving you the what-ifs. The weak part of the complex is the soybean oil. It continues to have the lower high, lower lows with the embedded reading. So you switch back and forth on crushes. Do you want the oil? Do you want the meal? What do you do when you crush it? Right now, the meal's in a bit more demand than the soybean oil, and that's seen on the chart as it's keeping its bearish flavor. In the corn market, we've hit now over the past week and a half twice the upper Bollinger Band and failed to pop through and stay over it, and so far today the same thing. The market is also in an overbought condition. So is it going to trend and try to lift a little bit, or is it just going to play games back and forth here? I can't answer that. I can tell you that the trend is up, the bias is up, but the market is overbought, and each time it's tried in the past, let's say the month of March and April, to stay over that 100-day average, it's got thrown back. When we look at the wheat market in the July contract, you now have a pattern of a lower low, a higher high. You went up today to the combination, and this is where you run into these big numbers. This is why learning some of this stuff is so important. You at least get to see the resistance before it comes together. Give you an example. Here you're looking at potential resistance on Monday at the upper Bollinger Band and the 100-day average. The market makes its move like I showed yesterday, 447.5 to 448.5. You're overbought. The market again tries that number today and gets thrown back a little. So that's not going to change. This 100-day average is going to be a resistance level for a while. Even if it gets over it, it probably pulls back the other way. Is there a trade there? Well, that's the question. You have an overbought market into resistance, not trending. In the sugar market, you have a market now that's got higher lows. Today's high took out 1689. Swing line is pointing up. You lost the embedded reason. The embedded slow stochastic, so there's every reason, again, my brain's faster than my mouth, for price and the 18-day average to make a run at each other. In the coffee market, I call this a big failure day. This market had a shot to pick itself up and make its move towards that upper Bollinger Band. Instead, it has an outside day down. There is no trend. The bias is back to the downside. This was enough of a correction to get out of an oversold condition. Is the market going to make a run towards the lower Bollinger Band? It was a frustrating day for the coffee traders. In the cocoa market, you had an inside trading day at the bottom of the recent break. You're oversold. The pattern has got a higher high and a lower low, so there's no trend. The market is, however, got downside bias because the market is under the 18-day average, and it's respecting right now the lower Bollinger Band. But there's nothing bullish on that chart. In the cotton market, here too, you have one of these patterns of a lower low, then you get a strong rally that fails, and you are oversold. Pretty hard to call a trend of any type there. In the cattle market, you rallied sharply today, and you're finishing right against the upper Bollinger Band. That number is 114.50. You finished off at 114.35. The market is overbought. The trend is up, and this cattle's been on a tear. But the problem is with an overbought condition into the upper Bollinger Band, I think the pros are taking money off the table. In the feeder cattle, you're overbought. 2 days in a row now of settling over the upper Bollinger Band gives the market, as I interpret that, about a 3% chance tomorrow of staying over that number. Doesn't mean it can't, but it means there's a 97% chance of it not. Why do I use those percentages? The way that I teach and understand Bollinger Bands is 5% of the time the market trades over or under a lower Bollinger Band, the black dashed line. Now you've got 2 days in a row over it. I've done a number of studies over the years counting how many successive days you have over or under. And my work has led me to the point of 5 to 7 is the typical range, with 5 being where the mean, really everything centers around that number. You can stretch to 7. Therefore, I subtract 2 of those days from the 5 and I get a 3% probability. I'm giving you the rule of thumb. It's not super scientific, but it's better than what most have out there, and I'll stick with what I've said. So I think the market's a bit vulnerable. What I don't get is yesterday's action in the hogs. Late in the day, something took this market over this high, drove it sharply higher in the last 3 minutes, 4 minutes of trading, up to 7,400. Couldn't figure out what it was at all. It opens today lower, and I swear to you, in no time at all, this market was down 200 points. Then it spent the day trying to bounce and then give that up late in the day again. Probably algorithm traders, but again, another failure against that 18-day average of closes. Not very bullish in that. Let's talk a little bit, though, about when I say I don't see what the chart action is. A lot of that is answered in the research that our company writes, and they write daily about the fundamentals, the cash prices in the hogs, for example, the grains, how many cargoes are at sea, how many are being taken by China, what's going on in the futures, who's doing the buying, selling, what's the most obvious plays that are taking place in the options that they're seeing in the pit. You get all this. This is what our hedge accounts see. We want you to see it for a limited time. You either have a trading account with us, or you're buying our research in some manner, or you're not getting it. It's really that simple. But you can choose from the different categories, and I think you'll find that this information's unique in what it does, very, very indispensable, and it's the reason we have clients with us, one of the good reasons for it. How do you get a sampling of it? It's real simple. Give my staff a call at 866-973-2077. You can go to our website, you can sign up for it, and you can choose the different categories there that you want to get it on. You don't have to get it on every market. So you'll see the, if you will, on our front page, our carousel of free offers, or right up here you can click, and when you click that, what will take place is this icon that you see on YouTube. It'll open up the form, you take it the rest of the way. One other thing. I know a lot of people watch our disclaimers and all that go on this. YouTube's not going to allow where we say skip and you go forward to the tape. It has nothing to do with us. They're making a change. You might want to write them about that. We don't understand the logic of not allowing that annotation, and if they hear it from enough people, they'll put it back on. I'm Ira Epstein. You have a great day.